Hello, my name is Leah Kratz, and I'm one of the co-authors of your financial accounting textbook. By now, I hope you've had a chance to look through and read, as well as think about our chapter on other non-current liabilities. There are a lot of things that show up in this chapter that companies engage in, and I hope that you have a chance to talk about them with your professor, talk about them with your classmates, and think about what these represent. Again, we want you to be able to look at a set of financial statements and understand what it is you're seeing and what those items represent. Hopefully you've had a chance to think about your top 5 most important things from the chapter. Here's a list of my top 5. Compare them to yours. See what you think. Where are they different and where are they the same? Here we go. For me, the 5th most important thing is the concept of off-balance sheet financing. Now, this is a term that we talked about when we learned the historic rules for accounting for operating leases. Although we no longer use this method for accounting for operating leases, you may still encounter off-balance sheet financing in other areas of accounting. So I wanted you to be familiar with the terminology. Off-balance sheet financing is when a company has an obligation, but for some reason or another, they are not required by FASB to report that on their balance sheet. As you would imagine, companies love this. They have the ability to finance their operations, but not show the obligation on their books. And although the FASB has changed the accounting regulations for operating leases to where they have to report that obligation, again, it is still something that you may encounter at some point in the future, so I wanted you to be familiar with it. Again, my pick for number 5 is off-balance sheet financing. For me, the 4th most important thing in the chapter is the debt-to-equity ratio. Now, this is a ratio that's very easy to compute. You take your total liabilities and you divide it by your total equity. This ratio will give you a lot of information about how individuals in the organization are making decisions and what their strategy is. Because of that, a lot of individuals will use this ratio to evaluate the organization and make decisions such as investing or lending money to the organization. What the debt-to-equity ratio is communicating is how the company is obtaining their assets. Are they obtaining their assets through debt, or are they obtaining those assets through capital investments or through operations? Now, a company that uses debt to finance their operations, that can be considered a very wise strategy because they're using someone else's money to make money. At the same time, this does present risk because all of the money that's borrowed has to be repaid, and it has to be repaid with interest. So if a company is unable to make those payments, they can be forced into bankruptcy. Again, the debt-to-equity ratio does communicate a lot about the organization and about the decisions they've made and how they're going to go about financing their operations. Because it's so important and because it's used so frequently by individuals that are making decisions, I place this as number 4. For me, the 3rd most important thing in Chapter 15 is the idea of the uncertainty that surrounds some of our numbers that are reported on a balance sheet. There is no better representation of this uncertainty than the amounts that are reported with post-retirement benefits. Post-retirement benefits are the amounts that companies are obligated to pay on behalf of their former employees. Examples would be things like health insurance, retirement benefits, and such. These amounts are really uncertain to calculate and to know because they're so far in the future. Also, we don't know how long we'll be paying these benefits because a lot of them are based on how long the individuals live. We can't possibly know how long someone's going to live. We also can't know how the costs are going to change over time. Because of this, the numbers are very uncertain. At the same time, these are very large numbers and very important numbers, and individuals like to see them reported. So for that reason, accountants do try to make the best estimates they can, and they use the services of individuals like actuaries to help estimate the amounts. The present value of those amounts are calculated and are then reported on the balance sheet. But again, there's a lot of uncertainty surrounding that. And because of that concept of uncertainty, I wanted to share that as number 3 most important thing in chapter 15. This brings us to number 2 on my list. The number 2 item for this chapter for me is the concept of deferred income taxes. Deferred income taxes are shown on a balance sheet, and they represent an amount of tax that is owed at some point in the future. Now, companies actually prefer having deferred income taxes. The reason is because income has been earned for financial reporting, but for some reason, something in the tax code is allowing that income to be recognized but paid for tax purposes at some point in the future. And as you can imagine, companies like that. If they have a tax bill of $1 million and they have the option of paying it today or paying it in 2 years, they certainly would want to pay that in 2 years, because in that time period they could use those funds and earn money off of that and make that money work for them before they have to pay it to the IRS. So again, these are very legitimate situations where a company has earned the revenue for financial reporting, but because of some rule in the tax code, the actual tax bill on that income is deferred until some point in the future. Companies do enjoy this benefit, and when you see that on a balance sheet, you know that that obligation for that tax is at some point in the future. For me, deferred income taxes was number 2 on our list. And that brings us to the first most important thing from chapter 15. For me, the most important thing was the idea of accounting for leases. As we saw, we have a couple different methods for accounting for leases. FASB has recently updated the rules for lease accounting regulations, and we'll explore those here. The first option an organization has for accounting for leases is a finance lease. A finance lease is really more like a purchase than a rental agreement. All of the rights and obligations of that property are going to transfer. And because of that, we're going to record it very similar to a purchase. All of the lease payments are computed and the present value of those payments are calculated. At that point, a right-of-use asset is placed on the balance sheet for that amount, as well as a corresponding liability. Over time, that asset is going to be amortized similar to it would be if it had purchased it outright. Also, the liability will be repaid with interest. Now, the FASB has identified 5 criteria that could qualify a lease agreement as financing, and if any one of those criteria are met, the lease agreement is considered a financing lease. The other option an organization has for recording a lease is an operating lease. Now, operating leases have changed significantly in the last couple years as the FASB has updated the lease accounting regulations. If any of the 5 criteria are not met, if none of the criteria are met, then the lease by default is an operating lease. But the FASB has determined that there does need to be an asset and a corresponding liability on the books, even for operating leases. So similar to a finance lease, the present value of the cash payments is computed and a right-of-use asset is recorded as well as a liability. Under an operating lease, there's going to be a standard lease expense amount every period. The interest on the obligation is computed and subtracted from that lease payment. The difference is going to go to amortization expense. So over time, as payments are made, the amount of interest that's reported goes down and the amount of amortization expense that's reported increases over the life of the lease agreement. Because lease accounting is so prevalent and it's so popular for many different companies, I place this as number 1 for Chapter 15. I hope you had a chance to enjoy Chapter 15, to read it, to think about it, and to really examine what you thought was most important. I hope you're learning a lot. I hope you're coming along in your financial accounting knowledge, and by now you're really able to look at a set of financial statements and understand quite a lot of the things that are going on within the organization. I hope this excites you, and I hope it makes you want to keep learning more.